Hey traders, Steven here. It's Thursday morning, October the 18th. Looking at the futures are down a little bit, but in a volatile market, or really just any market, I don't really care where it starts. I care where it finishes. And yesterday on Wednesday, it closed in the upper end of the range, so that's a positive, even though the market was slightly down. What we're looking at right now is we're going to look at some strong stocks today. We're going to run a scan to see what stocks are bucking the trend. But let's start with the overall market. This right here is a zigzag chart of the NASDAQ composite going all the way back to 2010. And you can see it's got a zigzag with a parameter of 10. And what that means is every little zag is a move of 10% or more. So you can see all the 10%, declines. Anytime it goes down, that means the market was down at least 10% and going all the way back. So you can see it's happened 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So we're on our 13th 10% pullback since the beginning of 2010. That's more than one a year. So, before people start talking about the sky is falling, I wanted to put this into perspective. Now, so you can see most of the time now we are in a bull market, it would have been a buying opportunity. Cause even though you don't always get in on the exact bottom, I think you would have done fairly well if you were to go more aggressive or to put money to work at any time the market was down 10%. Now, let's see how many 15% zigzags we have over the same time period. A lot less. You can see we have 1, 2, 3, 4, and it looks like right now we're trying to get number 5. I don't think we've completed it yet, but so I want to show you this just to show you, once you get rid of all the noise, right? All those daily bars and everything, and you just look at, the growth and the pullbacks and just kind of get out the noise, how easily it is to say, well, if I would have bought any time the market was down, 10 or 15%, I'd have done pretty well. Now, if you'd have waited for 15%, there'd have been several years in a row, 4, where you wouldn't have got that. And then it happened twice back to back, and we're not quite down 15%. I think it's trying to, but it hasn't made the bottom yet. So, 1, 2, 3, 4 times in the last 8 years, almost 9 years. So, to me, it seems like anytime the market's down 10%, it seems like an opportunity when you're in a bull market. Now, the key word is in a bull market. If we were to go to 20%, I don't know, we would have had 20% decline in 2011 in the NASDAQ. Now, this is NASDAQ, not the S&P. I don't think we've even had a 20% decline in the S&P 500. Since the bottom in 2009. And this is probably high to low point, not close to close. So just kind of keep that in mind before you say, hey, we were supposed to be in a bull market. I don't know if that happened. It's high to low, not close to close. So, it just goes to show you how often, these type of the 10, 15 type of corrections happen, just to kind of show you if you have a game plan in place. Let's go to 5%. So these are all the 5% downside moves. And, if you're constantly putting money away every month, this might not be a bad way to go about doing it. Say, okay, anytime I get a zigzag of 5% down, even though some way overshoot it, some get it just right. But I think over time, you're dollar cost averaging pretty nicely. So you always really want to look at the big picture on some of these zigzag charts or on your bigger picture game plan, just so approximately in the long term, how much better you would have fared. And whether it's 5, 10, 15%, I tend to be a little bit more biased to the 5 and the 10% range. I think you would have done very well over time. Now, looking at today's chart in the NASDAQ, you can see we have an 11% decline from peak to trough, and we're trying to come back a little bit. Now, I try to be as bullish as possible because a mistake I've made in the past is every time the market corrects, thinking it's going to turn into something bigger, get caught flat-footed, and then the market takes off. So I try to stay bullish until it proves me otherwise, just because I think you're going to make more if you stay a bull, no matter what the news says. One thing I do want to be cautious of, you know, these were all 10, 11% pullbacks. This is our third one of the year. The NASDAQ is still up pretty good. As a matter of fact, if I throw a performance, let me see if I could throw on a performance, price performance of the comp. Let's look at this. Okay, so 15%, but what if I, you know, start, let me kind of go back to this. I can start on January 1st, 2018, just to kind of see. Okay, so the NASDAQ is still up 10, almost 11%, regardless of year to date, regardless of these waterfalls. You know, I call them waterfall because that's exactly what they look like. It's not like a slow drip. It's just like bam, from top to bottom. Still up 10%. So the bigger picture is still up, but I want to be cautious because, you know, the personality has changed, even though the price action is in line with these two. The personality has changed because it broke the 200-day moving average the previous two times it found support. So even though it's climbed back above it, and hopefully we get a rally up into here before it takes another leg down, it's just something to pay attention to. Now I'm really laser focused on, instead of thinking that, you know, this is going to happen where it shoots right back up before it takes another leg down, I'm a little bit more cautious the fact that it overshot support, and now support is who knows where it is. And I had to go back to some corrections, which we'll look at. I'll go ahead and look at those now, because I did take a position when the market reversed. I had to go back and look at the corrections because naturally I'm thinking, well, the same thing is going to happen that it did earlier this year, where it found support, it bounced really strongly twice. Well, the previous three corrections before that, 2010, 11, and 15, that didn't happen. So you don't want to just look at the most recent corrections. You want to kind of go back to see all the possibilities. Now you can see this first one failed, but I think we're more down here. You can see it reversed. It went up a few days and then came back down, tested the low, went up again, rallied, didn't make it back above here like it has this year, and just chopped around the bottom. It's kind of showing me evidence that's what happened this time, where you're just chopping up. You could undercut the low, but you know, I think what happens over the next couple of days is going to really show us what kind of bounce we're going to have. Are we going to have a strong bounce where it sucks everybody in and then comes right back down? Maybe it undercuts it, maybe it doesn't. Or are we just going to bounce for a few days like we already have and then come back and undercut the low or retest the low? But it's just important. I know, you know, I was watching TV and they're all talking, well, look what happened the previous two times. And I'm like, yeah, but what happened the previous 5 times? And the previous 5 times says, you know, 3 out of 5, you don't, and this is 2011, which this was an awful correction, you don't get that high bounce all the way, you know, where it's, you know, trying to get to that 61 retracement dead cat bounce. It doesn't get anywhere close, and maybe gets to the 31 and then just chops around and spits you out. So, you know, the important thing is to, I think, when you're buying the bounce, is to try to sell some in a strength. And if it comes back, let it stop you out. Don't let it turn into a loser. Just nibble a little bit. Now, 2015, you can see that first bounce. It was a dud bounce. You can see it bounced a few days, came back, tried to get back. Maybe it bounced, you know, 4 or 5%, and then it came back, retested the low. Then there is your major bounce, and then it rolled over again. So, again, What I'm trying to identify is, are we going to get this type of bounce where it rolls back, or are we going to get this type of bounce like we have the previous 2 times earlier this year? I tend to believe, just because we overshot support, that it's going to be this, but again, that's just a prediction and it means nothing. I'm just trying to look at all the evidence, but it's just important for us to look at everything to be prepared, so there are no surprises. Now, if we look at the S&P 500, it doesn't look that much different. It, found support for the most part, only went below it one day, found support multiple times, and then had, right here, had a nice bounce, kind of came back and tested it, and then went way off, and now we're back here. It overshot it, and yesterday it did close in the upper end of the range, so that's definitely a positive the way I see it. So it could come around. I'm looking at this 20-day EMA, this declining, because what I have found in waterfalls, a lot of times it's going to get rejected twice at that line, just like it'll find support in an uptrend multiple times, right? It'll find support around that area a few times, and then it'll finally break. Well, the same thing is on the downside. When you're in that waterfall, it'll find resistance a couple times, then it'll break through, probably suck everybody in, and then roll back and retest the bottoms. Now, this is a weekly chart. This is the bull market, right? This just goes to show you, going all the way back to 2009, we've been in just a major bull market, rising channel. To touch this trend line, we got to come all the way back to 25.50, and this is kind of approximate, and I just kind of want to see, that'd be about a 15% correction from peak to trough, just to retest this major trend line. So when you look at this, it doesn't really look so bad. In the heat of the battle, it looks a lot worse, but we don't know what's going to happen. We just want to know what's possible, what's happened previously. And my recommendation was just, to trade light. If we do get just a major rally coming off this low, take some profits into some strength, just because we know, looking at every correction, last 5, the odds of it going straight up, coming out of here and re-entering the bull market, is not great. If we go back to, I remember the 2014 sell-off, it was only like a 9%, 8% sell-off. Man, it sold off and it bounced right back. It was V-shaped. You can see it's right here. Let me try to even blow this up a little bit. It was V-shaped. And I remember on this, everybody was thinking that this was just a dead cat bounce, and it wasn't. It went out and knocked out the high, and eventually it rolled over, but it, in my opinion, came out of here, and the correction or the pullback was over very quickly. So most of the times, that does not happen. Let me kind of get this back to normal. So again, big picture, sometimes you do have to be patient. These are just the first couple weeks, and if we look at all these corrections, all of them, they did not last just a couple weeks, okay? So if you get a price that you like, just put a stop right under it. And if it never comes back, great. If it does, let it go. Just get out of the way. Let the market go where it wants to go. You can try again later. Just kind of nibble at it. But there are months in the years where you shouldn't be over trading. I'm not going to say you can't trade, but you shouldn't be over trading. And if you're struggling, then you just need, in my opinion, kind of step aside and let a better market environment, or at least let market breadth improve. So this is the Russell 2000, and this was the only index on Friday that actually pulled off a reversal. Kind of an ugly one, closed in the upper end of the range, but it did undercut all the previous days, and it closed slightly positive. So to me, I'll be the most comfortable buying this reversal instead of buying something like this, that even though it did find support right here, if it was under it, I wouldn't be as comfortable because it didn't close, didn't show that institutional support. But this did, and then it closed again yesterday in the top end of the range. So could this come back around? You know, around the 1620 area, you got multiple overhead resistance. So since it broke support, now we got to assume that it could potentially turn into resistance. That's what I say, that if we're getting this rally, this dead cat bounce, and just maybe take a little bit off the top as it's rolling into strength, because these bounces can be incredibly, incredibly strong. And they can just make everybody feel all good inside. Then it rolls and cracks right over. So what you want to pay attention to is, you know, the 20-day moving average. If it rolls back over and starts to crack that, that's when I'd be getting out of a lot of things, unless my individual stocks are holding up. So there's a lot of things you have to look at. Don't worry, I got you covered. I look at them all. But, you know, just to kind of let you know, the game plan right now, at least for me, is to nibble, maybe sell into some strength, kind of see what it does. But I don't really want to give it that much of an opportunity to roll back over. So the personality has changed, right? The personality of the market has changed. So just like anything, and I teach it almost every week, when the personality of anything changes, you need to pay attention. I'm not saying turn from a bull to a bear, but I'm saying you need to now be open to the possibilities that we could be in a completely different market. So we have right here, let me see if I can inspect this. We're going to look at market breadth for a minute. Did it get below? Okay, so it came right down to 40, maybe even a little bit under it in this most recent correction. So again, on these pullbacks in the S&P 500 earlier this year, it didn't come close to 40. It got to 48 or something like that. But now it not only broke the long-term moving average, it got down to 40, which is major correction territory in breadth. Now it bounced back and it's at 50. But last time it broke the 40 level was in 2015, and there was a lot of chop. And that chop lasted, I mean, how many periods? 168 periods? I mean, about 6 months. So, the way I see playing this is to, when it bounces and gets back up here, I'd more try to buy it on the oversold reversals than try to let it suck you in way back here. Because I think the odds of you getting stopped out are almost the same. Why not get a better price? Actually, I think the odds of you getting stopped out are higher up here than down here, because, you know, it's so oversold. That doesn't mean it can't get more oversold. But again, if I'm looking at something, I'm like, okay, I'm going to nibble down here, see what it does. If it comes back and stops me out, so be it. But I'm going to try to sell into a little bit of strength. That way, if it comes back, hits me at the break-even point, I at least made a little bit, right? I made a little bit. But the breadth is not really looking so hot right now. Coffee break. So we got a breadth thrust to the downside. So this is the percentage of stocks above the 20-day EMA in the S&P 500. These are all the individual industries. Now, I don't really pay attention to this that much because it's just so short term, and I don't like to pay attention to too many things where you get too many signals, because the more signals you get, the more whipsaws you're going to get. And I don't like whipsaws. I don't like a lot of whipsaws. But it's important to just kind of look at it every now and then, to look at the evidence to see what is holding up. You have, right, 29% of stocks are the average in the S&P 500 above the 20-day moving average. I bet it'd be a good scan just to go through and say, okay, what 29, you know, what are the stocks that are still holding above the 20-day moving average? Because that's pretty strong right there. You have the technology, which is getting beat bad, is only 13%. You have the financials that's also looking ugly, which is interesting because financials usually follow interest rates, and interest rates are up and the financials are not. Something under the hood there in the works. Consumer discretionary, another aggressive sector, 20%, 21. Industrials, 12, so one of the weaker ones. Here is a shining star, the XLV, the healthcare. 61% isn't really a huge, strong trend, but man, the fact that 62% of healthcare stocks above their 20-day moving average, when the market is rolled over, they bounce back really, really good. You can see kind of the breadth and the bounce back in the breadth. Again, healthcare is the strongest. You have the XLP, which is the staples, your cereals, your cigarettes, your recession-proof type stuff. You're going to go and buy a six-pack regardless of a recession or not. So you got your staples. I know I am, at least. And then energy was really strong, and then it just got beat. You have materials, which is weak at 16%. And then utilities. 86% of utilities, a very, very defensive sector, is above the 20-day moving average. So, you know, outside of healthcare, the two strongest are staples and utilities, which is no surprise, but they are defensive sectors. So, again, you know, I'd like to see the bounce a little bit stronger in, you know, some of these financials, technology, industrial, and it really hasn't been. So that is giving me a little bit more evidence that this time could be different, or it could be more like a, you know, trolling on the bottom type of chop. So we'll look at healthcare, but, you know, keep this in mind. So you got healthcare, you have XLU, utilities, and then you got, where is that, staples. I want to show you a chart from John Murphy. And if you've never read John Murphy's book, I highly, highly recommend going out there and buying it, because it really helps you understand. It's called Intermarket Analysis, and it really helps you understand the cycles and the relationships between commodities, bonds, interest, all that. And it goes back a very long period of time. Because, you know, at least in my lifetime, we've been in a yield bear market. Now we're in a yield bull market. First time in my lifetime. I'm a pretty young guy, but, you know, that yield bear market started in 81, and now, so you can basically look at older models. So this is his model that he has studied over probably the last 50, 60 years, and this is the sector rotation model. And you can see right here that we'll look at this. The red line represents stock prices, and the green line represents the economy. So coming out of a recession, or headed into recession, you typically have a lot of the towards the bottom of the recession, you have cyclicals, industrials, technology that are strong because the market is forward-looking. They're already seeing the bottom of the recession. They're looking forward. Then the recovery starts to happen, right? And then in the later stage of that economic cycle, you know, you have materials, energy that start to do well towards the top. We've had energy recently do very well. And then when you're getting more towards the latter end of the business cycles, you have staples, healthcare, and utilities. And that's what we just looked at. So towards, and typically the market kind of peaks before that, which we're just seeing. We could be somewhere in this area where the market could be potentially topping, and we are at the top of the business cycle. Does that mean we're going to have another 2008? No, it just could mean we could have a weak quarter or two. It could mean something very small in a very, very long time horizon. But, you know, John Murphy put out this article on stock charts, and he has really done some amazing research. So sometimes it's just kind of important to look at these business cycles, and they don't always hold true, right? There is all kinds of decoupling, but I just wanted to show you this chart that John Murphy put up. And it's just kind of interesting that healthcare is really, really starting to lead. I mean, in a strong way. It by far looks like the strongest ETF. And right towards, you know, this area of the top of the business cycle. So we'll just kind of keep an eye on that. So, and then utilities and financials kind of lead as, you know, towards the end, and you can see it starts all over again. And this is a multi-year cycle, okay? 4 or 5, could be even 10-year cycle. But, you know, I think you have to be a Stock Charts member, but if you are a Stock Charts member, go check out this John Murphy blog, because this is some pretty legit type of stuff. Okay, corrections, China. Let's go look at China. China. Okay, so this has broken a pretty serious trend line. Last month, everyone's like, oh, it found support at this, almost 3-year trend line, and then it just snapped. I'd be very interested to see. I mean, this could head major lower. As we can see in the Chinese markets, they can head higher very quickly. The same is true on the downside. The Shanghai exchange broke a major support line, and if it whipsaws and comes back to the upside, I think that will start a new bull market. But this is important, and it's not important to the U.S. market, and I want to show you. S&P 500. Let's look at the correlation to the Shanghai with the U.S. market, the S&P 500. This correlation is all over the place, which is going to tell me that it's not really correlated at all because it has a mind of its own. I wouldn't say it's up here, maybe just a tad bit more than down here, but for the most part, in my opinion, the Shanghai market has no correlation to the S&P 500. Now, the S&P 500 has a lot of correlation to the Europe markets. So if you hear somebody say the Shanghai market's going down, that means the U.S. going down, I think there's enough evidence to say that doesn't hold true all the time. But my point is, a lot of the world growth is coming out of Asia. A lot of the world growth is coming out of China, it's coming out of Southeast Asia. When you have these markets start to slow down and break down, and yes, this probably has to do a lot with trade wars, and if they can get rid of this trade war, then maybe, this will change, but it is important. It's important, if you have international stocks, it's important, if you have a diversified portfolio of ETFs or mutual funds to just be incredibly cautious. I do manage a portfolio, for a relative of mine. Man, I got out of emerging markets earlier this year, even though I really love emerging markets. It's done really well the last couple of years, but I said, you know what? This chart doesn't look right. The death cross is happening, and I just got out of it and I moved it to U.S. stocks, and thank God that I did, because it had been down a lot. But my point is, with the international stocks are just dragging everything down, and the U.S. markets have been so strong. Now they're starting to correct, and now they're starting to change. I keep saying you need to pay attention and not fall asleep on this, because we could get into a completely different kind of market environment. I can't tell you how many people not a ton of people, but some people tell me I might sell too early. And I always say I try to put plans in place that will work across multiple market cycles. That way you don't have to always shift. So if I have a profit plan of 8 to 10% on half of my stock, and then it just runs and runs and runs, well, yeah, it's going to run and run and run because I'm in a bull market. But what if I'm not in a bull market? I hit 10% and then it comes right back down, stops me out at zero. Now I have a 5% gain. So I try to put plans in place where I don't have to adjust too much during different cycles. So you need to mentally prepare yourself. There will be a time where the bull market isn't a roaring bull market anymore. And you're just buying something and hoping it'll go up 50% might get a little bit harder. Stock picking might get harder. And if it does, momentum style trading systems of ETFs, I think work incredibly well. So China is headed down. VEU. So this is the VEU, the All World ex-US ETF. It broke a major trend line, 2.5-year trend line. No surprise. It got rejected. Tried to break out of its downtrend. Whipsaw, above average move to the downside. And that's something that Martin Pring talks about with stock charts. Again, he talks about a whipsaw one way, and a false breakout or a false breakdown is above average move the opposite way. And that's exactly what happened. Now, I have the dollar crossed over because you can just see how opposite they look. When the VEU is very strong, the dollar is very weak. When the dollar starts to strengthen, the VEU is starting to roll over. So the dollar is going to be correlated. International stocks are going to underperform in a strong dollar. Right now, it's looking like the dollar is ready for an encore on the way up. So just keep that in mind. So a different look at the dollar, you know, again, you have this inverse head and shoulders breakout. That's clear. It tried to break down and then quickly came back and recapped. So this could be a nice move to the upside. We'll just kind of have to wait and see. This could be a little mini inverse head and shoulders. If you draw a neckline around that, around 95.50, that would continue to put downward pressure on emerging markets, on international stocks. It could help out small cap stocks because in a strong dollar, typically small caps outperform the S&P 500 because a lot of the large caps have a lot of their sales overseas. So a strong dollar hurts their sales, where small caps, they're not really affected. So money kind of piles into these small caps because most of their sales are US based. So just keep that in mind. Strong dollar, small caps typically outperform large caps and international stocks, typically. So that is looking strong. What else did I want to touch base on? I wanted to touch base on really the, let me move over here to the West. Actually, let's just look at West. Nope, I know what I wanted to look at. Commodities. So it's kind of interesting because the commodities, the CRB has started to be strong. And I think it's mostly has to do with a lot of agriculture lately. The ag is starting to get stronger. You have it's starting to kind of move higher with the dollar. You can see right here. But, you know, if I were to draw some lines right across here, I would have said, you know, this would have been, you could draw a neckline right here. I could say this did break out and is now coming back. I'm interested to see what the CRB does. It could either roll back over or go strong. But with the dollar strong, they're kind of moving together, which typically they have an inverse relationship. So again, you don't just want to buy any commodity just because the CRB is strong. You want to kind of dive deep into, you know, miners and metals and oil and agriculture. Just like industry, you want to buy the strongest industry and the strongest sector. Same thing with commodities. Commodities is a basket with a major weight on, you know, West Texas or Brent crude oil. I don't know which one, but either way, as a major in oil, and then just has a slew of commodities. So, you know, they are coming back. Sometimes it's just a sign of inflation, which is why we're raising rates, but we'll just kind of wait and see, because this, to me, hasn't really built anything. But, you know, if this does pull back, it's either going to roll over or build a cup with handle. If it builds a cup with handle, I would say that's definitely bullish for commodities. I want to finish off with a screen, because right now, you know, my favorite thing to do when the market is pulling back is to find out what is not. What is bucking the trend? What is holding off? And you can do this, you know, multiple ways. You can just screen, you know, what's above the 20-day moving average. You can, you know, screen by relative strength. Different screener tools have different relative strength calculations, but they're all pretty similar in my opinion. You know, what's outperforming the market? So I'm running this relative strength line new high screen just to kind of look and see what is really bucking the trend. And you got 20 names here, so we're just going to go through some charts real quick, and we're going to end off with that. You have Guardant Health Incorporated, GH. Looks like a pretty small cap, a new IPO, but it's got some very good sales growth. Obviously not profitable yet. Still yet to be seen, but I don't think the market likes it. It's gone from 30 to 41 very, very quickly. So to me, it's gone straight up. Maybe this needs to consolidate a little bit. You have AMRN. This is another biotech. A lot of biotechs have came out, and this one went from 250 to 20. So I don't know why. If you want to look at that, I'm going to pass on that. Vale, mining, South American, Brazil, mining stock. Good return on equity. Year-over-year earnings acceleration, kind of spotty sales, but they have increased the last 3 quarters. Rising relative strength line. It is about to report in 6 days, but you know, this is looking like a pretty good chart. Accumulation at the bottom. Repligen, if I said that correctly, again, something that's looking kind of strong. You have a strong relative strength line. This is clear as day what I call steady Freddy type stock. And that's just a stock that's just going to go at a 45-degree angle. It's going to find support at that 10-week moving average. Pretty neat and clean. Looks pretty good. It did just have a recent earnings negative, but it's supposed to accelerate year over year. Return on equity is nothing to write home about. But again, chart looks interesting. Bank of Butterfield, Nutterfield. Bank of NT Butterfield. This is a Bermuda-based bank. Very, very good numbers for a bank. That's a very high return on equity for a bank. Very good earnings, good sales. Obviously, the stock has made a pretty good move. It's doubled since its IPO. You kind of got to look at the personality of the stock, right? It goes up a little bit. Really looks like it only pops on earnings almost. So it looks like it's going to report soon, but you can see all these moves started right after earnings, and then it kind of pulled back. So you might just have to buy and hold this one if you like it. GHDX, another medical products. Again, we're seeing a theme in the healthcare sector. I don't know anything about this, but earnings are expected to grow 60% next year with a revision up. So it's very, very positive. It's already made a pretty strong move, so that might not be my cup of tea. Healthcare, HCA, revisions up in earnings, very, very strong. Sales aren't that great, but it's a mega cap. Steady Freddy, looking good, very high relative strength line. Another medical products. And guys, this is not just a medical scan. This is a universal scan of growth stocks, and the fact that all the medical devices and products and biotechs are the ones that are leading this should just show you how strong this is. Merit Medical Systems, 28% earnings growth this year. Lamb Weston Holdings. Don't know anything about this one. Sales are meh. Earnings are okay. But it's in the food packaging industry, and it made a huge move on earnings, and it's just off to the races. So it's not a very sexy industry in my opinion, but I'll take that price action all day. Progressive Corp and Insurance, PGR, major deceleration next year, but very good return on equity. The institutions love a high return on equity. I've studied some of the best growth stocks. My favorite is the return on equity because I've noticed they're well-managed companies as long as it's not deflated by a higher debt load. This looks pretty good. Vanda Pharmaceuticals, let's see, average volume 1 million. You can see you kind of have a shakeout pattern, right? Because it tried to break up, gapped up. You might want to research why it gapped up right here. Came back, found support, overshot the 20, found support at the 50. It's trying to bounce out of there. So that's a pretty good looking setup. Earnings are estimated to go up 900% next year. ZTS in the drug, medical ethical drugs. Again, 73% return on equity. Man, it's just kind of a steady Freddy. No, it doesn't always find support at the 50-day moving average. I bet if I were to draw a 100-day moving average line, I bet that's where it's finding it. But it's in a very strong long-term uptrend. Ladder Capital Corp, a REIT. Here's what stands out to me. Obviously, that's good, the upwards projection, but you got increasing mutual fund ownership from 193 to 268 in 4 quarters. That's pretty good. Someone likes it. It's got a 7.4% dividend yield. It still hasn't came even close back to its peak, so it's got a strong relative strength. It's rising because of something. A REIT that originates in mortgage and mezzanine financing. Sounds like the Big Short to me. Renewable Energy Group, REGI, nice return on equity, very strong energy alternative. This to me kind of looks already gone. Anthem looks like a steady Freddy. Nice, neat, finding support along that 10-week moving average. Upward earnings revisions, decent return on equity. Medical managed care, man, it's just all about the medical. McCormick, another food stock. Good return on equity, earnings revision up, Sales went from single digits to double digits. I'm assuming that's why it made this monster move. I think this could be early in its move. Just, you know, I don't like it up here. Maybe it consolidates, but this stock to me is saying, what correction? Like, there's so much strength behind it. It's not going anywhere. Premier, commercial services, healthcare. I'm kind of seeing a theme not only in the healthcare, but in the stocks. These green arrows means the earnings were recently revised up. How many more we got? Okay. Grand Canyon Education. Look, good return on equity, decent sales. You can see right here that it came down and it found support and it's trying to build a cup. I think it needs to build a handle. But look at all the accumulation on the right side of this base. That's showing pretty strong. That's really what you want to see. Service Corp, 24% return on equity. SCI, and is just holding that line right up here. So we'd probably need to consolidate for me a little bit more because it's already made a big move. But there's plenty of stocks, Euronet, there's plenty of stocks that are just showing a lot of strength. This stock looks extended right here. This one really, really would be my cup of tea because I like year-over-year earnings acceleration. So next year is higher than this year because Wall Street always is forward-looking. Nice return on equity. Nice gap up, but it's about to report. So always know where you're going to report.